All right, guys, I just want to go over something that I think is a good idea to help you trading going forward. Um, there's things called flags. There's pennants, flags, and typically a flag would look like this. Okay, market went sideways. Market went sideways, and then let me just fix this. You have this breakout from what we call a sideways line. See, when you have all these bars going sideways, that's called a sideways line. Or just basic. It's basic technical analysis 101. From there, typically you would get a breakout. From there, you will get a pullback. Okay, these pullbacks are called flags. All right, and they look like flags. Okay, they look exactly like a flag. They're also called continuation patterns. So the market rises. Okay, so these are called continuation patterns. Breakout, you got a retracement, and then continuation. Okay, here you see the market once again went through this sideways line, started rallying. Okay, actually still went through the sideways line, this whole sideways line. Market rallied out of that straight up, right? Market gave impulse to the upside and is now forming another flag. You can see this. This rising flag, as I said earlier, and I know we got new people that are just coming in, this rising pattern is very bullish. Okay, very bullish. Now, if you were to trade this, your stop would be under here. Okay, when you're trading this, you look at stops underneath where it broke out from. So this right here is very bullish. This leads me to another thought of market profile. Okay, a thing called market profile, market auction theory, or auction market theory. So the markets they trade as if they are in some type of an auction. All right. So when they're down here, right, they come out of here like this, and everybody's agreeing. Everybody's agreeing on the price. Like right here, when everybody agreed, everybody agrees on the price. All right, everybody's agreeing at 1.0841, 1.0841. That's the fair value. That's a fair number. That's the fair price. Okay? Everybody's agreeing. Buyers and sellers are all in agreement right here. All right? They're all in agreement. So okay. Everybody's right in agreement right here with price. Everybody agrees. The buyers and sellers both agree with price. So what's he talking about? Okay. All right, guys. So yeah, no new trades going on this weekend. So since everybody agrees to the price, you are in what's called a sideways line. And what happens is it creates this value area. This is where everybody's comfortable, right in here. Okay, this value area. Value area is created like this. So let me take some Fibonacci. All right, let's just have a little fun here. Okay, let's say this is 30% and this is 70. That's 30. This is 70. Okay, And this right here, so just, follow my thinking for a bit. So you have markets that go into ranges. And you see it, right? You see this. Markets go into ranges. And we have what's called the value area. This is the value area. This is where most of the action has taken place. All right. So right in this zone, I'm sorry, and I did this wrong. I got to fix this. Let me just fix this. My bad. Hold on a second. Sorry about that. There we go. Oh, I can't even do this right now. Okay. This is where 70% of the action has come from. Okay, going forward. So the middle of this is called a point of control. This is value area. This is where the market feels. I'm doing a video. I'm doing a video. I'm doing a video. Um, okay. So this is where the market feels that it's a fair price in this zone. All right, it's a fair price. From that, let me just erase everything, just so you know what it looks like and what the reasoning is. Just right here, same example. Okay, so let's start again. Okay, just so you guys all on the same page with me. Where 70% of the main action has taken place. And this is called a point of control. All right? Point of control. And this is why just following the market's actions will uh, keep you on the right side or keep you on the wrong side, right? So let me just scroll over. All right? Scroll over. We're just going to look at this spot right now. So this is an area that the market felt was in agreement. This is where traders, little traders, younger, inexperienced traders get hurt. Traders get hurt, okay, because they're trying to guess the highs and lows. They're trying to guess all this, okay? And all this stuff here, you see all this? This is all faking out members or people, I'm sorry. This is all fake outs. Okay, this is how when it starts to break out, you're thinking, oh, it's going higher. So what they call a fake out breakout. All right, that's a fake out breakout. Now don't get me wrong. This push right here led to a retracement, led to a test back up. It failed to go further. It tested down, it tested up again, and tested down. At some point, people were looking at, well, it's gone. This is the thinking. Ready? Watch. Market goes up, people buy it. All right, all the big players, boom, buy it. They're out. The smaller players thinking this is going a lot higher. We're going to get a measured move up, and it fails and brings them back to this area down here, where traders think, well, you know, I got to short it. We're in a range, and it grabs them and drives them back up again, and they think that's it. We're breaking out again, and it drives them back down again. Now, at some point, they figured out that, well, if this was a buy and this was a sell, and that was a buy and this was a sell, this got to be a buy, right? You know? So, and this is how the thinking is in the markets. So they buy it, and then the big people drive it lower. The big money drives it lower. Bang. You see that? Then you get, from that point, we all know the process. Pull back. So drive 1, drive 2, drive 3. 3 drives down. You see that? So we all know, and we discussed this before, 1, 2, 3 drives down. And you're right, Mark, if it wasn't for big money, what we call smart money, if the smart money, if it wasn't for them, you'd be sitting in value areas all the time because the market would stay in agreement at all one time. But it tips to one side. The market tips to one side. It's similar to, you have that game. You got the participants here. You got participants here. And then you got the knot, tug of war, right? At some point, it's going to tip to one side and everybody's going to flip over. Everybody's going to flip over. So it's similar to like tug of war. Big money's buying. All the banks are buying. All the banks took position, So now everybody's in agreement. All the big money, the smart money says, you know what? We're going down. We're going to go down. And we're going to drive them down. And we're going to drive them down. But now this is an area that used to be of value. Okay? This area used to be of value. Right in here. Oops, sorry. So lower value area, upper value area, control point. This area used to be at value. So market likes to attract. I'm just teaching right now, Diego. I'm just teaching. Market likes to attract to different value areas. You can see right here. It attracted in here. Okay. All this. You can see when the market came up, when it broke back above here. Okay. This is considered value area. And you can see right here, look, market hit it, backed off. Market hit it again, got above it, and exploded. Why? This is support, resistance. It's just, you can see it right there. It's evidence, okay? Market stopped going down, and bang. All right, once it got above. So this is value area. Market went out of value, rally up, boom, 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 back to value, out of value, drive, 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 done into value, right? I'm taking you through the sequence. So all this from the past is relevant, okay? All this from the past is relevant. This is why I'm always looking at the past, at what patterns have done. It's all relevant. Even right here, when this hit, look at that. When this hit here, it was hitting this, but it just broke out of a long sideways line. Longer the line, the longer the drive. Okay? Longer the line, the longer the drive. So now, market has now gone up. A lot of impulse. Everybody wanted to buy. Auction market theory. So they all agree that 810 is good. 810 is good. And in the thinking of if we were on the cattle range, I know one of our guys here is Scott. I'm not sure if Scott's on with us this morning. I'm going to beat him up if he's not with us. No, he's not on. So he owns a cattle, right? For instance, they bring cattle to the auction or a car auction. You guys see the car auctions on television, and you're getting this. And this is how it's actually reading if somebody was doing an auction. 810, 810, 810, 812, 812, 812, 812. Anybody buying at 816, 816, 816. Anybody buying at 812, 810. All right? 811, 811. How many times are going 811? Down to 807, 807, 811, 811. Back and forth, back and forth, back and forth. And it's bidding 810, offering 810. Bidding 810, offering 810. Bidding offer 809, bidding 811. Bidding offer 9, or offering. Bidding, offering. Bidding, offering. You see? Everybody's in agreement right here. Everybody's right here in agreement. And then also, bang, it starts going. They hear 815, 815, 815, 821, and they start going up like an auction. So that's what's happening, is a crowd mentality, is everybody's trying to get on the side where everybody's starting to go. But if you think of this in the auction theory, where they're actually reading the prices, since it's going sideways like this, it's going like this. 8-9, 8-9, 8-10, 8-10, 8-9, 8-09, 8-11, 8-09, 8-11, 8-09, 8-11, 8-09, 8-11, 8-12, 8-12, 8-13, 13, 13. Everybody got 13, 13, 15, 15, 18, 19, 19, 19, 17. Do I hear 18? Do I hear 18, 20, 20, 20? So it starts picking up. The volume starts picking up, and the auctioneer is going, do I hear 24, 24, 24, bid 24, 24, 24, offer 26, offer 26, offer 28, blah, 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 blah. Sold, okay? Right here, sold. But it's that crowd mentality. I can't really do it that fast, but become that crazy auctioneer, and it's driving the market up. And it comes into that resting period where the markets have broken out, and they all come and they rest. They all start selling, and then they're buying again, and now they're going back into the area of value until somebody says, I'll bid 35. And somebody says, okay, I'll sell it to you at 35. And somebody says, I'll bid at 30. Somebody says, I'll sell it to you at 30. And they start selling it, and before you know it, everybody's gone. Nobody wants to be there anymore. And they're trying to sell it. They're just selling it. Nobody wants to buy it, and they're just selling it. And they're back down to the prior auction price, that prior value where everybody was content with agreeing on the price. And once everybody agreed that this price down here was the bottom, you can't stop it from going up, because now everybody wants to be in. Everybody wants to be in. And most of the time, and so you see this, if you see the way the price action is here, everybody's not really so, they're buying and selling. But it's when you start to get a little bit too far that everybody wants to be in. Right? iMarkets Live went sideways for a while. And all of a sudden we started getting attention. Right? Or here, we started getting attention. Went for a year worth of attention. Growing, 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 growing. And all of a sudden it's like more. And all of a sudden now I'm getting calls from master distributors. I'm getting calls from company owners. All of a sudden all the big people coming in. Everybody needs to be in iMarkets Live. And at some point it's going to peak and go sideways. That's just normal. It's normal course of business on any instrument, any market, anywhere. So, you see what value is? Then you go back into what's called that sideways line. sideways line. Okay? I'm just using I hope iMarkets Live doesn't go sideways. I hope we go up forever, but you got to be real. Okay? Every company goes through growth and sideways and down and up. And we went through enough down over the, past couple of years, and we went up pretty good. But so you've gone sideways long enough here. I don't know if I use iMarkets Live as an example, but whatever, it doesn't matter. The point is, you guys understand. So you've gone through this sideways line, this extended sideways line, and nobody wanted to take control of one side. They brought it down here by trying to sell it, and they got stuck uh, because they tried to sell it out of the range, and the buyers took it back up. And when they got up here, the sellers came back in control, and then the buyers took control, and then the sellers took control, and the buyers took control, and the sellers took control, and the buyers took control, but the sellers couldn't push them down too far, and you had that first little flaggish, but you had a big range here, right? And then the buyers came back in again, and once they came above, everybody wanted to be in. Auction market theory. Okay, auction market theory. Okay, it's the auction market. This is the theory. Everybody wants to be in. It's went sideways so far, it needs to go up, right? Then it goes sideways again. It goes sideways again. So until, right? Until it gets above here, until it gets above there with impulse, let's just say it goes like this, and like that. So until it goes outside of it, you're still going to sit in what's called a sideways line. This is where most people get hurt. I don't like looking for markets that are in sideways lines. However, I do like looking at markets that are like this, that are forming particular patterns, where maybe a harmonic pattern is something. Harmonic patterns are great in ranges. Harmonic patterns are great in ranges. They're also great when the market does this, okay? And you're in an uptrending environment, and it forms that bullish pattern. Or if you're in a sideways environment, right? The market's been going sideways, and it does like this, okay? Okay, and what had happened was you're forming ranges with the market above. So two ways to look at harmonic patterns. One is in a trending environment, and another one is in a range environment. You see? Hector Seda, welcome back, man. Mark was telling me you weren't feeling so well. Hope you feel better, brother. All right. So anyway, this is what's called auction market theory. These are unfair lows, unfair highs. This is, they got all sorts of little terms for this. But this is how auction markets work. And if you understand the trading environment, this is how trading works. You're looking at it as patterns, but the market thinks in terms of auctions. It doesn't think that you got this bull flag. It's just a natural occurrence from the auction market. So when you're looking at something like this, market rallied up, and now it's getting that consistent, it's holding, and it's forming that this sideways line came out. It's now forming that consolidation because everything's out of the range now. Now it's starting to consolidate, and the buyers are starting to accumulate. As it starts to accumulate, we're going to start seeing better impulse to the upside. So I thought I'd share that with you. It's a little class we did here.